Howdy, Jacob here. Today I'm going to be doing an in-depth analysis on FinVolution Group. So let's do a reminder. Just quickly, the previous time I did it, my assumptions had it essentially a screaming deal. But let's look into some new assumptions as well as just reviewing the report itself. So, just a reminder, it's in the consumer finance industry. It is based out of China, and so the shares are advisory shares held in the Cayman Islands. Um, Nothing, I mean, that was what made, the stocks like Alibaba and JD.com fall so much. But as they claim, you really don't have if you own the ADS, you don't own the claim of the actual company. But um, this will just be a review of the company itself, not necessarily debating whether having the shares outright or ADS is this, that, the other. But from a balance sheet perspective, what I learned from reading a bit from Ben Graham is that what people used to call cigarette butts or cigar butts, where they're considered net in the basis of their balance sheet. I wouldn't say this is a cigar butt by any means after looking at all of their revenue growth and their margins and such. I think this is a business that is thriving in Shanghai. I think that the consumer finance industry is just a bit novice, and so I think people are scared of how to necessarily value it. But a net, for example, just in this most basic case, is when you look at the total current assets on hand and you subtract out all of the liabilities of the company, what you could liquidate almost immediately from the business. And so if we look at the most recent year, we see 2.71 on the current assets and 1.28 on the total liabilities, which nets out to about 1.4 billion, and we can see the market cap is less than that. So if all of their current assets were to be sold at the value that they are on the balance sheet, you could liquidate the company for more than what it's worth today. So that's not necessarily saying that the company should liquidate it by any means, but it's more so a review of safety, where if worse comes to worse, the company falls a bit more, they do have the ability to sell off essentially the parts for greater than what your initial investment is. And it works especially well with companies that are profitable. Obviously, a cash burning company that has a balance sheet that looks like this doesn't really mean much because they're just burning through the cash that they have on hand. But again, I want to go over more into that later. This is really a FinVolution specific review. And so again, 4.54% on the dividend yield screener, or the dividend yield. And it looks like the payout is more than reasonable, where they pay out about 50 million. And if we look at a 5-year average, it's well over 100. And so just want to go over some of the notes that I pulled out from reviewing quarterly reports in their 20F. Just understand that the 20F is essentially the international company's 10Ks equivalent. So again, I've already gone over, it's an ADS, so it's an advisory share. It's based out of Shanghai, China. The online consumer finance industry is young compared to most industries within China, making the future income and cash flows more difficult to predict. This was just one of the hindrances that the business outlined in their 20F. But it's also for someone who's going to estimate cash flows, it might be a little tougher. So you might want to increase margin of safety due to just being so young and pretty unknown. So I noticed when I looked at their insider share ownership, it was 21.6%. So this is a good amount. It's a healthy amount for smaller companies, and it's really not even that small. It's a $1.3 billion market cap, but for something that's relatively small in the small cap range of size, I I definitely prefer higher on the insider ownership because that means that management will likely do things that are truly in the best interest of shareholders as they represent a good amount of those shareholders. And I also wanted to point out that the 4 co-founders of FinVolution are still present on the board of directors as of right now. So it's a young company, founded in 2007, as I stated, and all 4 of the co-founders are still present on the board, which is good. Makes sense why they have such a high ownership of insiders. Their transaction volume for international is increasing around 100% year over year on the revenue side, and their mainland of China revenue is increasing roughly 10% year over year. This is looking at the last couple quarterly reports. Obviously, that sounds amazing, but you have to keep in mind that the international currently makes up about 4% of the total transaction volume. So pretty dampening when you look at, it's increasing 100% year over year, but it's such a small amount of the actual company. But even 10% year over year for the China mainland is pretty impressive. Their margins appear to be slightly pressured due to credit losses for quality assurance commitment. So this was just looking at a line item and realizing that for quality assurance commitment of people paying back their loans is dampening margins slightly. This may be a long-term thing. Maybe they distributed out loans to more people than they truly should have per se. But for a company that's like this, that does what FinVolution does, a lot of companies are going to have credit losses. So, it's just understanding the risk model and seeing if it still holds or not. So CFO says that excess free cash flow will be for share repurchases and dividend payment to optimize return to shareholders. They have consistently bought back shares. And then to the right, I have 2 snapshots of their 2 most recent 20F filings, and you can kind of see where they buy back shares. So the first one is in 2021. There wasn't a whole lot of buybacks. If you look where the stock was during this time between February 21 and November of 21, you can see that it was between 5 and it got as high as $9 a share. So the good news is they weren't buying it when it was what appeared to be excessively expensive. And then now that it's been lower recently, they've been buying back quite a bit more shares. So it looks like when the price is over 5, they don't buy many shares. And when the price is under 5, they buy quite a bit more. So it seems like the company itself is thinking that share repurchases are very healthy for when the price is under 5. And so they're doing a good job at buying back shares at what appears to be the right time. If it goes down to $2 a share, it could look ugly, but what we'd hopefully see is that they're buying back a greater quantity of the share backs at a cheaper price. So in August 2023, the board approved share repurchases up to $150 million, which represents 10% of the market cap. So their board has consistently approved share repurchases, which, if you think this company is cheap right now, is good to see them buying back shares when it's cheap and not when it's expensive. And then the final thing before I get to a final overview is at the end of 23 Q3, less than 1.2 billion in total liabilities and roughly 1.6 billion in cash equivalents, short-term investments, roughly 750 million in receivables. Taking all of these current assets and subtracting out all the liabilities gives just under 1.2 billion. And again, the market cap is roughly 1.3 billion. And so it looks like it could be a net company based on the balance sheet. And so if I incorporate my new assumptions here, which have slightly increased revenue, decreased margins, and then the terminal P and price free cash flow is quite a bit different due to what I saw in their history. Their history has been quite a bit lower on the P ratio and price free cash flow ratio wise. And so I put in a lot lower than my initial assumptions, and that gets me to a price. And again, I think the dividend payout is fine, 3% increase. That gets us to a price where it needs to fall 45%. So I went over quite a bit here, but hopefully this was an informative video and you learned something, and I hope you have a great rest of your day. Thank you so much.